With you a stock this guy had, a client I was working with. He had a list of 10 BDCs. I assume that's business development corporations, and I'm not very familiar with these things at all. But he has a broker, I think it's through Ameriprise, who sold him a bunch. My initial thought process was somewhat concerning because I said it had a pretty significant high dividend yield. In fact, let me show you. So this one is called Tpg Specialty Lending. So I just said, give me one. Let me look at it, and I looked this up. And I want to share it with you because I think it's interesting, actually. This is called Tpg Specialty Lending. The ticker is TSLX. And what you see here is if you go on down, you see a sweet. So you'll see the 7.44% dividend yield. And so that's pretty high, which kind of concerns me, actually. But, REITs and preferred shares have a high dividend yield or high yield. So that in of itself doesn't make me concerned. But then you see his earnings PE ratio of only 9.83. I said, man, that's pretty good. So they're making money. They have positive earnings, and they have a high dividend yield. So I started saying, okay, that's good. And I said, let me just take a look at what this stock has done. It really hasn't done much. I mean, since it was initiated, the IPO looks like in 2014, it's probably issued at $15 a share. It's now up to $20 a share, almost 21. So not a lot of growth. I mean, that's a nice growth rate. Don't get me wrong. It's 33% over 5.5 years. At the end of the day, you're not buying this for growth on the stock. You're not buying it for compounding interest or compounding growth. You're buying it for the dividend yield. So I said, okay, that's good. But I always get scared about these stocks that have a high earnings, a high dividend yield. So I said, let me just look at the data here. So let's look at financials. All right. So what we're going to do is we're going to go. Yeah, right here. All right, so we got, I wonder if I can pull, I guess I can't. So anyway, here's a trailing 12 months is what the TTM stands for. All right, so we're going to look at trailing 12 months and then the year to end of 2018, 17, whatnot. So let's just take a look. I want to look at debt. Debt is the killer, man. Always will be the killer. Forever will be the killer. No other way around that. And I wonder if I can get this. Why is it not showing debt? Okay, do I got to go to something else? Hold on just a second. All right, so, okay, let's go to right there, balance sheet. That's what we want. Here we go. Okay, cool. So they got, $10 million in cash. They get $8 million in receivables, and that just means that's cash payments to come due. So essentially $20 million in current assets. That's what that'd be called, current assets. They got $1.7 million of equity and other investments, and I imagine the bulk of that is probably in real estate. They have, let's just keep going down here. Long-term debt is $608 million. And they have total liabilities of $667,000. Total liabilities of $667 million, not thousand. At the end of 2018, they had total liabilities of $750 million. So their liabilities went down quite a bit. That's interesting to me. Their liabilities went down from $750 to $667. In 2017, their liabilities were $723. In 2015, it was $696. So their liabilities are lower now than they've ever been since this guy came to fruition in 2014. Total stockholders' equity is $1 million. So they have a debt to equity of about 67%, which is actually pretty low. Debt to equity of about 67%. So you take your liabilities, divide that by your stockholders' equity, and that's your debt to equity. Last year, they had a total stockholders' equity of $969,000 with liabilities of $750,000. The year before, they had liabilities of $723,000 with total stockholders. So you can see the debt to equity numbers are actually going down, which is good, and that's impressive to me. So, all right, so they got a lot of assets, all right, and obviously a lot of debt too. They don't have much cash, $10 million, and another roughly $10 million in receivables. So that's their current assets. All right, so let's keep going down here, and that's as of the trailing 12 months. So I like that. Let's go to cash flow because we want to see where is their cash coming from. So net income, I mean, they're making $138 million a year. That's not so bad, man. So net cash provided by operations is $29 million. So they're making $29 million of net cash according to operations because let's keep going down here. Debt repayment, they paid $800 million back in debt. The year before, they paid $1.17 billion back in debt. That's interesting to me. Are they refinancing it? I bet that's what they're doing. I bet they're refinancing their debt. and they're paying it back and paying a portion of the debt principal that they have down as well. So they're refinancing $800 million, I should say, and they're retaining $667 million with a refinance. I bet, I don't know. Now here's the kicker: they paid $98 million of dividends. $98 million of dividends so far this trailing 12 months. $98 million of dividends. All right. So their cash flow is they have $138 million of net income. And that's including everything. So that's interesting to me because that says that free cash flow after dividends is $30 million. So I mean, think about this. You take their net income, $138 million, all right, and then you say, okay, they got $90 million of cash of dividends paid. So essentially, this is what happens: you take 138, subtract your dividends paid, and essentially you got $30 million of free cash flow. Isn't that interesting? So they were able to pay the dividend, all the while making money, all the while increasing their operating cash flow. Were they able to do it the year before? The dividends paid the year before were $95 million, and their net operating revenue, their net income was $119 million, $111 the year before, and they still had operating. So they have never had to take debt in order to pay the dividend. Now, I don't know what this other debt stuff is. I don't know. I imagine to buy buildings. I mean, let's go to their balance sheet. What is the assets in terms of their long-term total assets? So it's equity and other investments. Oh. Is it real estate? I don't know. It says real estate here. Yeah, it's not real estate. So what they're doing here is they're taking money. They're not investing in real estate. Now, this is the concern I'd have. And while the market's doing well, they've been able to make money and pay a significantly high dividend and actually reinvest and pay down debt. So they took a bunch of debt in order to invest. That's what they've done. They've taken those investments. They're paying a high dividend to get people to invest in their profit, their company. They're making money. They don't own anything other than intangible items, which would not be real estate, which would be investments of other firms, other companies, of whatever it would be. Maybe even lending it out. Yeah, that seems kind of risky to me. The reason I say it because while the market's going well, the numbers look good to me for sure. I mean, my goodness, they're making money. They're paying a significant dividend. That dividend is being paid for by cash flow, but the cash flow is all based contingent on the market performing. The investment world, the intangible asset. A tangible asset is something you can hold. Gold, silver, your home. That's a tangible asset. An intangible asset is stocks, bonds. That's interesting. Anyway, I figured I'd share that with you. Yeah, I'm not sure I'd be investing in that. The numbers look good. That might be something that you take a flyer on. Now, when I say flyer, some people mean that means you bypass it. I don't mean it like that. I mean, that might be something you put some of your I don't say play money, your aggressive money. You say, I might buy something like this. Because if it works out, you're going to get a fat dividend, man. Now, again, dividends are not compounding. Actually, I don't know how it works with these guys. I'm not sure if they reinvest the dividends in the shares. They probably do, actually. If it's a preferred stock, doesn't work like that. If it's I bet this is not going to compound. I don't know. Bonds don't compound. Bonds, you just get the interest. It doesn't reinvest in the bond. I don't know how this would work, but if you're getting 7.5% as a dividend yield with an earnings per share of PE ratio of less than 10, they're paying down their debt. They have enough positive cash flow to pay the dividend and retain some income as well. Again, if the market were to go south and a credit crunch would happen, that might be problematic. But that might be an aggressive portfolio. And again, I don't think did I talk about beta? Yeah, I think I did. Right, I talked about the beta. Their beta is only let me just show you statistics. Was it here? I can't remember. But they have a profile. They had a beta of 0.63%. I can't remember if I talked about it here or not, but maybe I did. But anyway, They have a beta of 0.63%, which means they're not tracking the S&P 500 dollar for dollar. So I want to say it's a non-correlated asset, but it's definitely not highly correlated to the S&P 500, which is, where did it go? Which is actually pretty good. That's what you want. You don't want a highly beta, because that means if the S&P 500 falls, you're going to fall with it. Anyway, just something to think about. Where is the thing? Maybe it's not in here. Maybe it's on the laptop. All right. Something to think about. I thought it'd be interesting to share with you. That might be something to look at. Look, I'm not advising this. I don't know. But it's interesting to me to see how that shakes out. So that might be something you put on your watch list. All right, we'll see you.